Okay, let's dive into this. Welcome to The Explainer. Today, we've got a seriously fascinating financial mystery on our hands. We are looking at an absolute foundational pillar of enterprise software. A company that practically built the modern digital workflow. And we're trying to figure out a massive puzzle. Is this company fundamentally broken, or has the market just handed us the investment opportunity of a decade? From $218 billion down to $98 billion. Yeah, you heard that right. That $98 billion figure represents ServiceNow's staggering market cap compression. Back in 2024, this company was valued at over $218 billion, but by mid-May of 2026, that valuation had completely compressed, with the stock price plummeting roughly 50% from its prior peaks down to around $95 a share. So the obvious question here is, why did a foundational pillar of enterprise software suddenly lose half its value? Did the core business completely fall apart overnight? Well, the short answer is no, not at all. To really understand the panic that triggered this massive equity collapse, we have to zoom out. We need to look outside the company and examine a broader macroeconomic shock that literally rocked the entire software sector. Which brings us to Section 1, the 2026 SaaS apocalypse. So the crucial point is this idea of seat compression. This is the exact narrative that terrified institutional investors and sparked a sector-wide sell-off. Traditional software as a service relies heavily on selling licenses or seats to individual human workers, right? But what happens when an autonomous AI agent can suddenly execute the workload of, say, 10 human employees? The big fear is that the software provider loses the recurring revenue for those 10 individual seats. And this fear just went into absolute overdrive in early 2026, specifically after Anthropic released Claude Code. That agentic AI tool basically proved to the world just how capable these systems had become at handling human-level workflows. If we look at the timeline, you can see exactly how this panic escalated. Back in 2019, per-user models were the absolute gold standard. By 2022, we started seeing a shift, with about 61% of SaaS companies moving towards usage-based models. But the real earthquake hit on February 3rd, 2026. The sudden realization that AI agents could actually wipe out these legacy seat models caused a sector-wide capitulation. It tanked the software sector ETF by 4.8% in a single day. The market just blindly extrapolated this fear across all software companies, and ServiceNow got completely swept up in the algorithmic liquidation. Let's look at how they are responding in Section 2, the AI Control Tower. Now, what's really interesting about this slide is how perfectly it illustrates the market's fundamental misunderstanding of ServiceNow's actual business. Wall Street punished them as if they were just another simple application layer software, the kind of easily replaceable tool that AI could just gobble up. But that's not what ServiceNow does. They are an enterprise orchestration platform. They don't just host isolated tasks. They are the highly defensible connective tissue across a company's entire IT stack. Think about it. When you have thousands of AI agents running around a Fortune 500 company, you absolutely need a governance layer to make sure they don't hallucinate or leak highly secure data. ServiceNow is building that exact control tower. And they aren't just talking a good game. They are literally spending billions to build this out. They recently closed a massive $7.75 billion acquisition of Armis. The goal? Expanding their reach from digital workflows into physical operational technology, so their AI agents can now securely manage everything from factory robotics to hospital devices. They also scooped up Visa for deep, granular data access control and dropped another $2.85 billion on MoveWorks to build a conversational front door for humans to command these agents. Throw in their new context engine, and you've got a system practically guaranteeing that AI agents operate safely within corporate environments. Plus 130%. That is the staggering year-over-year growth rate in Q1 2026 for customers spending over $1 million annually, specifically on Now Assist, which is ServiceNow's proprietary AI suite. Far from fleeing, enterprise customers are actively expanding their financial commitments to get their hands on these AI capabilities. So according to their own reporting, they aren't being cannibalized by AI. They are successfully, massively monetizing it. Let's transition to Section 3, fear versus financial reality. And this brilliantly illustrates the massive disconnect here when you contrast the market's extreme bearish sentiment with the actual cold hard first quarter financial metrics. The story changes completely. Total revenues hit $3.77 billion, growing 22% year-over-year. But the truly critical metric here is current RPO, remaining performance obligations. This is basically contract revenue expected to be recognized within the next 12 months, and it actually expanded by 22.5% to $12.64 billion. Those are locked-in contracts that heavily insulate the company from short-term volatility, completely contradicting the narrative that this is a collapsing software business. The cash generation here is also just off the charts. Out of that $3.77 billion in total revenue, they generated $1.66 billion in free cash flow. To put that in perspective, that is an exceptional 44% free cash flow margin for the quarter. They are operating as an incredibly efficient cash-generating machine, which gives them unparalleled flexibility to aggressively buy back shares and pump money into research and development. Okay, so if the top-line growth and cash flow are so stellar, why did the stock suffer its worst single-day drop in history, plummeting 17% right after earnings? Well, the friction essentially comes down to margin compression and geography. That $7.75 billion Armis acquisition, it's expensive to integrate. Management was very clear that it's going to create a 200 basis point downward pressure on full-year free cash flow margins, dragging GAAP gross margins down from 79% to 75%. And as we know, institutional investors absolutely hate it when pure-play SaaS margins contract. Compounding that, management also flagged a minor 75 basis point revenue drag because some deals in the Middle East slipped due to ongoing geopolitical instability. But check this out. This merge and panic actually created a wild pricing anomaly. If you compare ServiceNow to a mature peer like Salesforce, the numbers are fascinating. They are both trading at roughly a 21x forward price to earnings ratio, and they both have very similar free cash flow margins hovering around 35%. But here's the kicker. ServiceNow is growing at 21.1%, while Salesforce is growing at just 8.4%. You are essentially getting more than double the growth for the exact same forward valuation multiple. Let's move to Section 4 and see how this builds into an absolutely fascinating look at corporate confidence, the insider buying signal. $3 million. When a stock plummets, one of the best indicators to look at is human behavior, specifically what the people actually running the company are doing with their own money. In late February 2026, Chairman and CEO Bill McDermott deployed over $3 million of his own personal capital on the open market to buy 28,682 shares of ServiceNow stock. This wasn't some scheduled programmatic purchase. This was fully discretionary capital thrown directly into the teeth of a massive software sell-off. And McDermott didn't mince words about it either. He publicly stated that this seven-figure purchase was driven by absolute conviction in the platform's long-term trajectory. He directly called the compressed valuation multiples a highly compelling entry point. Listen, it's one thing for a CEO to jump on an earnings call and tell Wall Street everything is fine. It's a completely different ballgame to write a $3 million personal check to prove it. And that conviction trickled all the way down. In early 2026, several top-tier executives actively went in and canceled their automated 10b5-1 stock selling plans. Canceling these pre-scheduled sales effectively screams to the market that they'd rather hold their equity than liquidate at these distressed prices. And at the corporate level, ServiceNow executed a massive $2 billion accelerated share repurchase program in Q1, retiring over 20 million shares. That's double the amount they repurchased in all of 2025 combined. This is a powerful, symmetrical indicator of undervaluation from the people who know the company's inner workings best. All right, bringing it all together now in Section 5, the final investment verdict. Synthesizing all of this, the macroeconomic panic, the incredibly strong underlying growth, and the insider buying brings us to the technical chart for mid-May 2026. The stock is currently battling in a very specific zone. Primary support has established a firm floor around that $87 to $88 level. On the upside, it's testing immediate resistance near $95, stretching up to about $101. But the real level to watch is what's being called the magnet zone between $104 and $106. Why? Because that coincides perfectly with the exact price level where CEO Bill McDermott executed his massive open market purchase. It creates a very strong psychological magnet for price action moving forward. And despite all the noise, Wall Street overwhelmingly seems to agree that the downside here is totally overblown. Even after the steep 50% drop and all the panic surrounding AI disruption, analyst consensus remains insanely bullish. We are looking at 46 buy ratings against just 4 holds and 1 single sell, with an average 12-month price target sitting around $143. That implies a potential upside of over 50% from the $95 level we're analyzing today. Which brings us to the ultimate long-term thesis, $30 billion. Management has firmly reiterated their baseline target of hitting $30 billion in subscription revenue by the year 2030. To get there from where they are right now, they only need a compounded annual growth rate of about 18%. And given that they are currently growing the top line at 22%, they actually have an ample margin of safety to hit this ambitious goal, especially as that AI-specific pipeline continues to scale up. So, as we wrap up this explainer, we are left with one vital question to ponder. As ServiceNow completes its transition into the ultimate AI orchestrator, will the broader market finally recognize the huge difference between a vulnerable, isolated SaaS application and a highly defensible enterprise-grade moat? For those looking at the rock-solid fundamentals and heavy insider buying, the real question is whether this is a sneaky value trap or quite literally a generational buying opportunity. Thanks for learning with me today, and I'll catch you on the next explainer.